Want to get rich from stocks with little money? Here's how. Hey everyone, it's Hassan. You see these success stories of people making a killing in the stock market, and you want a piece of that action, right? But there's this little thing called starting capital that seems to be a roadblock for many. Trust me, I've been there. But you absolutely don't need to be a millionaire to start investing. What you need is a solid strategy, and that's exactly what we're going to break down today. We're going to dive deep into how to own stocks with minimal investment and squeeze every ounce of potential return out of your hard-earned money. Here are key steps to help you own stocks with minimal investment and maximize potential returns. Stock market 101. Before you throw your money at it, listen up. Before we talk strategies, we need to make sure you're not diving into the deep end without knowing how to swim. The stock market can be intimidating, but it doesn't need to be. When you buy a stock, you're essentially buying a tiny piece of that company. You're betting on their success. There are different types of stocks: growth stocks, value stocks, and dividend stocks. Growth stocks are the hyped companies, value stocks are undervalued gems, and dividend stocks pay you a portion of their profits regularly. Understanding these basics is crucial before you put your money on the line. Brokers, your gateway to the stock market and how to avoid getting ripped off. To buy stocks, you need a broker, the middleman connecting you to the stock market. Some brokers hit you with ridiculous fees that can eat away at your profits, especially if you're starting small. Big fancy brokers want the whales, the big spenders. But you've got options. Zero-commission brokers like Robinhood or M1 Finance have changed the game. They let you buy and sell stocks without charging you an arm and a leg. If you're dealing with limited capital, fractional shares are a lifesaver. You can buy a fraction of a share in expensive companies like Google or Amazon, even if you can't afford the full share price. It's like getting a taste of the pie without having to buy the whole thing. Chapter 3. High-growth stocks, ride the rocket ship to potential profits. High-growth stocks are where things get exciting. These are companies growing at a rapid pace and disrupting industries. Think Tesla, Square, Zoom, companies that are changing the game. How do you identify these potential winners? Look at their financials. One key metric is the price-to-earnings ratio, or PE ratio. It tells you how much investors are willing to pay for every dollar of the company's earnings. A high PE ratio usually indicates high growth potential. Also, look at their revenue and earnings growth. High-growth stocks can be volatile, so it's important to do your research and not get caught up in the hype. Chapter 4. Diversification. Don't put all your eggs in one basket. Diversification is your best friend, especially when you're starting with a smaller amount of capital. Spread your investments across different sectors like technology, healthcare, real estate, and so on. This way, if one sector takes a hit, your entire portfolio won't go down with it. Index funds and ETFs are fantastic tools for diversification. They allow you to invest in a basket of stocks with just one purchase, making it super easy to spread your risk. Outro: start small, invest smart, and watch your wealth grow. I'm not going to promise you'll be a millionaire overnight. That's not realistic. But if you're willing to put in the work, educate yourself, and follow a disciplined approach, you can grow your wealth in the stock market. The name of the game is consistency. Make investing a habit, even if it's just a small amount every month. Over time, those small contributions can compound into something significant. Take what you've learned today and start building your financial future, one stock at a time. If you found this helpful, hit that like button, subscribe to the channel for more videos like this, and I'll see you in the next one.